we don't participate, we anticipate. Make money in the market, it is very easy. So if I am positive about automotives, if I am positive about metals, if I'm positive about healthcare, you will see that kind of exposure coming through in the Flexi cap. The structure of the portfolio and holding lesser number of stocks, 24, 25, 23 stocks, the portfolio creates some element of volatility. The market cap to GDP ratio is at its peak that corporate India today has on its balance sheet is at its lifetime low. So markets may not continue rising at the speed and pace at which we've seen them rising. Thank you all for spending time and coming in and listening to us. We want to share our story, we want to give you a perspective of what we do at Oldbridge. And let's keep this conversation free flowing instead of मैं एक ज्ञान देता रहूं. Please feel free to ask me questions because I think that'll help us to iron out a lot of questions that you have, especially given how the markets have last 1.5 years, broader markets have flatlined. So let's keep it engaging. I think market kahan hai, right? That's the common trend. That's the common question that we've been asking, that we've been answering. So this is market cap to GDP of India. And as you can see, last 2.5 years, it's been quite elevated. Okay. Now, market cap to GDP as a trend, if you do a time series, मतलब एक isolation में मैं आपको 100% number दूंगा, तो शायद से आपको नहीं समझ में आएगा, शायद से you might not be able to make reference out of it. But if you see it through a time series analysis, you will come to know कि, are things more expensive or are things more cheap, right? And clearly at its peak, the broader market seems to be slightly elevated, okay? And clearly last 2 years, you've seen it to be sort of flatline, which is what has happened, right? Broader index, 26,200 was what Nifty hit a peak of on 26 September 2024. And after that, it's not really moved up. So we will get on to this and I'll also walk you through how we've seen it happen in the past and why we think there is a way around it. The only thing that we have to be mindful that the way around it will take some time to emerge, but there's definitely a way around it. Sorry. So I think one reason why the market cap to GDP ratio is at its peak is also because the debt that corporate India today has on its balance sheet is at its lifetime low. So think of it this way, that when you're trying to give money to someone who's already got a lot of debt, you'll always have a increased element of risk. Okay, there's a lot of financial risk, and that financial risk is something that the market doesn't like. And that's why historically we've seen this to have an inverse ratio. Wherever the debt of corporate India is high, the valuations of corporate India have been favorable. But the fact that the debt of corporate India is actually low now, valuations are where they are. What it does, it essentially means that corporate India is not bearing any solvency risk. Matlab, no one's going to go bankrupt. And if no one's going to go bankrupt and you don't see a risk in corporate India, it also means that the markets are not going to collapse. Okay, so markets may not continue rising at the speed and pace at which we've seen them rising, but because corporate India is risk-free right now from a balance sheet perspective, you will possibly have a situation where the markets will probably continue to remain sidelined for some time. Now, I'm just going to move forward to, come on to, So that 132% that we saw market cap to GDP, that's essentially this peak that we saw, right? And this is very similar to what we've seen in the past. So if you see on the chart above, from 2003 to 2013, the Sensex gave you about 14% return per annum. But most of that 14% return of Sensex going from about 6,000, 7,000 points, 6,000 points to 21,000 points actually came in the first 4 years. So you had a situation where the first 4 years you made good 37, 38% return per annum, and then for the next 6 years you didn't make any money. So on a 10-year horizon, it seems like you've made 14% return. okay, which is effectively what's happened with BSE 500 or broader markets in the period of 2020 to 2024. From about 18,000, when your broader market goes up to 49,000 in a span of 4 years, you've actually ended up making 28% return, okay, which is great. But you know, the fact is that there's no free lunches, right? You don't continue making these. I mean, at some point of time, reality has to catch on to what the facts are. And in that sense, we are in that, so to say, a phase of consolidation that we've seen in the broader market. And for those reasons, we believe that the broader markets may continue to be sideways. Again, I'll come back to my earlier point where I explained that the likelihood of broader markets capsizing is very low because corporate India is so strong. The debt on corporate India's balance sheet is so low, right? But the broader market, we don't know where it's going to play out. This 48,750 number today, as things stand, is close to about 45,000, right? So it's been about 1.5 years of consolidation that the market's gone through. We believe that that consolidation may continue. So the next question is, अगर market नहीं करना रहा तो हम लोग क्या करने वाले हैं, right? What are we going to do? See, it did not, if the markets went sideways, it did not mean that you didn't make money. Okay, and that's the second foundation of what we do at Old Bridge. We don't participate, we anticipate. Okay, so for you to make money in the market, it is very easy. कि आज से 2 साल पहले you know, defense was expensive, अब defense cheap हो गया, तो let's go buy defense. I mean, I'm just giving an example. It's not specifically context towards defense. Or we'll give you some data points to sort of provide that point. See, in that era of 2003 to 2007, when the broader market inched up by 37% per annum, almost all of that growth was driven by commodities, real estate, corporate banks. And as you can see, you know, L&T, NTPC, all these businesses gave you an annualized return of anywhere between, you know, 35 to 45, 55%, right? Now, if you entered the market in December 2007 thinking कि boss last 4 साल तो बढ़िया पैसा बना है, यहाँ पे पैसा लगाते हैं, you were in for a tough ride because those were the returns that you would have ended up making in the next 6 years. But if you had realized that after the global financial crisis, you know, IT is a big space that's going to emerge, India's competency in exports is going to emerge, you know, and would have positioned your portfolio correspondingly, from 2007 to 13, for anyone who was exposed to a consumption driven name and export driven name, ended up making a lot of money, right? So that is why it's very important for people to sort of anticipate which are going to be the winners of the future, instead of thinking that these which have done well in the past, they're cheap and they'll continue to do well in the future, right? And that's the second cornerstone or foundation of what we do at Old Bridge. Now, this was the broader view on the markets. Now, who are we? What do we do at Old Bridge? What is the focused fund all about? What is the Flexi Cap fund all about? I think for both those funds, there are some principles that Old Bridge operates with. And those principles are very simple. You try to buy great businesses which are going through a difficult business cycle. Okay. What it does is that when the cycle turns, the industry cycle turns, you get two advantages. One, the industry which had many participants historically ends up being an industry which is far more consolidated and you have far limited participants. Number two, a person who was doing exceedingly well or was the strongest player in the industry when the industry was going through a bad cycle, when the cycle turns, that customer or that player ends up coming up with a very good market share. Think of it as, you know, betting on Virat Kohli in a bad form. Okay. Now, when you bet on Virat Kohli in a bad form, his form is going to turn. The question is, you have to make sure that you're betting on Virat Kohli. Okay. And that's essentially what we do. The other advantage that we get in doing this is that because the industry is going through a bad cycle, you tend to get these businesses at a reasonable valuation. And that's where my margin of safety gets established. Okay. How do I figure out whether this guy is Virat Kohli or not? Okay, the way I figure it out is on two counts. One, that business has to be a market leader or a business which is taking market share away from the leader of the industry. Okay, so market share is very important for any portfolio company that comes into any of our funds. The second thing that we focus on is that that particular business has had to have a very good track record of deploying capital, in the sense a very consistent track record of making a return on capital more than the cost of capital. As long as I have a business which is either an aggressor or a consolidator, meaning either taking market share away or is the largest player in the industry, and he's consistently demonstrated making 50s or hundreds when the times were good, those are my strong businesses. As long as they're going through a bad industry cycle, those are the places that I'll continue to focus on. Any questions? Because this is something that you will see fairly consistent. That's a thread that binds most of our portfolio holdings together. So as we called out, it's going to be consistent. We're going to be having the largest business, a capital efficient business, and on most of the times a business which is going through a bad industry cycle or the valuations are in our favor. So what do you get with a focused equity fund today? A focused equity fund, because we're always anticipating, rather than participating, and because we like great businesses going through a bad cycle, we will never be consensus. You will always get something which is not there in any other portfolio, okay, which is not there in the benchmark or represented in the benchmark in a big way, for the simple reason that it is our view that it will be represented in the benchmark 3 years later or 4 years later. So what you get today is a fairly contra business, a fairly active view. Almost 90% of our exposure is active exposure when it comes to benchmark. The second thing that we're trying to do with our portfolio is that instead of creating multiple thematics, we're trying to really create a bespoke tailor which is harnessing all the trends in a single portfolio. Whether you look at the focused fund or you look at the Flexi Cap fund, all the trends which will drive our growth for the next 4 or 5 years, that's something that we're trying to harness. And it's a portfolio not for the faint-hearted. So because industry cycles take time to reverse themselves, there's a certain time element that we come with. So when we invest into our businesses, we invest into our businesses with a 3 to 5 year time horizon at least. And for those reasons, that's the metric that you all used to also. I mean, if I'm investing into a business with that time horizon, the investor which is coming into my fund should also come with that. I've always said and I've always maintained that we're competitive and margin of safety is supreme. So when you look at the valuations of our portfolio, we're at 11x versus the benchmark at 13.3 when it comes to EV EBITDA. On a PE basis, it might seem that the portfolio is more expensive, but if you see today the components of our portfolio, a large portion of our portfolio is either ending or is about to end its large capex cycle. And what happens is, I don't know how many of you are students pursuing finance, but what essentially happens is some of these businesses have very elevated depreciation with no corresponding revenues kicking in, and that's why their earnings are slightly depressed. But EV EBITDA as a metric sort of takes care of that. Even though we think that the broader markets will continue to remain flatline, we think there are certain industries and certain spaces which will do exceedingly well, and that's where our portfolio is positioned. Now, why do I say that? If you look at pharmaceuticals today, the total pharmaceutical industry in India today is roughly $55 to $60 billion, split 1:1 between domestic, which is the domestic consumption and exports. From a period of 2026 to 2035, there's almost $700 billion of patent peak that's expiring in the US. That $700 billion, you bring it down by 90%, bring it down by 95%. I leave the math to you. But for an industry today which has a base of $25-30 billion, that's a significant opportunity that sort of opens up with them. The second thing that's happening in that industry is hitherto you were only focused into the US market. Now, in the last 3 or 4 years, especially in the last 1.5 years, these businesses have started focusing on Europe. These businesses have started focusing on Latin America. And that's where we think, and all our businesses have their capex behind them. So they've got free capacity, they've got markets tied up. It's only a matter of time when the corresponding earnings start to deliver. The second part of our portfolio is actually automobiles. I think what people don't know so well, I mean, India is great in automobiles, but about 1 in 4 cars that get sold in South Africa are actually manufactured in India. Okay. About 1 in 2 motorbikes that get sold in Nigeria are actually manufactured out of India. So while automotives and OEMs have been a domestic consumption play, what we're seeing is whatever scale that they've created domestically, all of that is going to get into exports. So what IT did for India from the late 90s till maybe 2022, 23, what pharmaceuticals did from 2005 to 15, and then the market pivoted towards domestic, and now we think there's a new trend that's coming on the export side. We're going to see a similar trend playing out in automotives and the entire value chain, and that's where we are sort of positioned. The other trend that we think will do reasonably well is the power space. Okay, but that's the space where our exposure is limited because, as I said, margin of safety is foundation to what we do, and that's a place where we don't think valuations are comfortable. But to feed into whatever is happening there, to feed into whatever is happening in the automotives, what India needs is metals. And for those reasons, we've got a pretty sizable exposure in metals. India also has a unique advantage where, unlike some of the industries where we could be dependent on some other countries for its raw materials, we're completely integrated when it comes to metals, which is the mines, the processing, the market, and the export market. So that's where we think 2026 to 30, that's where we think India is emerging, and that's where our portfolio is positioned. You see the large cap, mid cap, and small cap composition into a portfolio. We don't focus as much onto it because if you see, most of the businesses or almost all of the businesses will either be the largest business in the industry or the second largest business in the industry. So our focus is always on the size of the industry and what the market share of the business is in the industry. If the industry happens to be small, it ends up being a small cap business, but the attributes of the business would be broadly similar, and that's the market cap movement of the portfolio is actually a function of the underlying philosophy. That's the portfolio performance. We started out in January 2024. We're about 865, 866 days in operation. The first year was about putting the portfolio together. Since inception, as you can see, that's our performance, that's the benchmark returns. And in the last 1 year, where the broader markets have been slightly challenging, the portfolio is held in good stead. So that was the focus product. Moving on to Flexi Cap. So again, as I said, right, the foundation is same, the strategy, the philosophy is same. The question that you would have is why Flexi and why now? I think there were 2-3 fundamental reasons why we came up with a Flexi Cap portfolio. One, because of the structure of the portfolio and holding lesser number of stocks, 24, 25, 23 stocks, the portfolio creates some element of volatility. Uh, we said we will, feedback that we received was that probably we need a product which has lower volatility. So that was one problem that we tried to solve. The second is when we went into the marketplace and we saw the broader suite of flexi cap funds. Today, almost 75% of funds in the flexi cap category are actually allocated to large caps. And we felt that if 3/4 of your category is hugging large cap, then the likelihood of that category giving you returns which are near to nifty is quite high. And that's essentially what we saw when we went back and tried to test data. Out of the 34 funds that are present in the 39 schemes that are present in the flexi category, you've not seen players more than 40% at any given point of time consistently outperforming the benchmark. Now, given the structure of our investment philosophy where we are focusing on largest player in the industry and not specifically a large cap business, we felt this is a problem that we could sort of solve. And the third thing is, when you're covering a space, you have a lot of ideas in mind, but you're not always able to implement those ideas because you have to run a fund with only 24, 25 stocks. We said, I have a market product, I have a problem in the industry, and we have an ability to solve it. And that's how we put together a product like FlexiCap. So in essence, you won't see our portfolio being significantly different in terms of sectoral allocations. So if I am positive about automotives, if I am positive about metals, if I'm positive about healthcare, you will see that kind of exposure coming through in the flexi cap. But if my exposure in healthcare is through 3 businesses in focused, in flexi cap will be through 5 or 6 businesses. In automotive, it will be through 4 businesses. In metals, it will probably be through 5 businesses. What it does is it helps me comply with, or it helps me participate in the sector which I think is going to lead India's growth, but on a more risk adjusted basis, reduces the volatility of the product and solves all the problem that I sort of called for. That's the positioning of the portfolio. Again, the focus is on the larger participants in the industry and not specifically on the market cap. But as I called out, 75% of flexi cap industry AUM is in the large cap space. From my vantage, that number is about 25, 26%. And that's why I think it's a good addition. It solves for a problem and it's a nice complementary product to have. It's a fund that we've recently launched in March, and therefore our performance, I don't know, Tav, have we started disclosing?
No, because SEBI regulation says only after 6 months of portfolio.
Okay, so that's something that's happening. And then the third fund that we have in the portfolio is our arbitrage fund. So again, market demand was that you need a place to park funds temporarily till you figure out where you want to eventually deploy. And for those reasons, we came up with an arbitrage fund as a parking fund for you to eventually take a call and get onto either focused or flexi cap, right? So it's okay if markets have been elevated. It does not mean, it's okay if the markets don't make money. It does not mean that you're not going to make money. The only thing that you have to do is you have to be smart about it. You have to anticipate what's going to come in your way instead of thinking what's already played out will continue to play. And that's where it becomes difficult, because when you're actually anticipating, you're trying to work on grounds which are not treated before, and when there aren't a lot of people trading onto ground, that's where you make the maximum money, because those are uncharted territories. From our view, we've been followers of cycles for the last 35 years. I've been fortunate enough to have really honed my skill under Kenneth, who's been doing it for the last 35 years. And it's not 2003 to 2007. It's not only India. We've seen it happen globally. The top 10 leaders in 1980s were very different from the top 10 leaders in 1990s, were very different from the top 10 leaders of 2000s.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.